Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to discuss depreciation. We're going to look at two different ways to calculate depreciation in the Accounting Fundamentals exam. We're going to look at straight line depreciation and compare and contrast that to reducing balance depreciation. So yeah, let's get into it. Okay, so there are a number of different methods that accountants can use to calculate depreciation, but for the purposes of your exam, you only need to focus on the two most common ones. The first is straight line depreciation. This is the simplest and most widely used method of depreciating a non-current asset. Under this approach, the exact same pound amount of depreciation is charged to the income statement in each year of the asset's useful life. It's ideal when the asset is expected to provide the same level of income or economic benefits in each accounting period. The second method is reducing balance depreciation. This method charges higher depreciation in the earlier years of an asset's life, and it also charges lower amounts of depreciation in its latter years. Reducing balance depreciation is used when an asset is expected to lose most of its value in its earlier years, and it's commonly used for depreciating vehicles or technology-based assets such as computers. Cars, for example, tend to lose a significant portion of their value in the first year or two of their life, so the reducing balance method can reflect this by allocating a larger depreciation charge in the earlier years of its life and a smaller charge in its latter years. So over the course of the next few slides, we'll explore both methods in detail. We're going to look at the logic behind them, the formulas that you use to calculate them, and how to apply each method by using a worked example. So the first method we're going to explore in a bit more detail is the straight line method. So using the straight line method, the asset's depreciable amount, that's the cost of the asset minus its residual value, that amount is spread out evenly over the asset's useful life. That means that an identical amount of depreciation is charged in every accounting period. And that creates a smooth and consistent reduction in the asset's carrying value over time, hence why we call this depreciation method straight line. The formula for calculating annual depreciation under the straight line method is cost minus residual value divided by useful life in years. And if you ever need to work out depreciation on a monthly basis, you calculate annual depreciation and you take that amount and you divide that by 12. The straight line method is most commonly used when the asset is expected to provide the same level of economic benefit in every accounting period over the life of the asset. So for example, office furniture and machinery are commonly depreciated on a straight line basis because they typically generate the same level of income for a business in every single accounting period. Okay, let's walk through a numerical example of straight line depreciation. So we're told that a business purchases a non-current asset for £55,000. The business expects to use that asset for 5 years, and it estimates that the asset will have a residual value of £5,000 at the end of those 5 years. We've been asked to calculate the annual and monthly depreciation charge, as well as determine the carrying amount of the asset at the end of each year. So let's start with calculating the annual depreciation charge. So to calculate annual depreciation, we subtract the residual value from the cost amount. So we take the £55,000 cost and we deduct the residual value of £5,000. That gives us a depreciable amount equal to £50,000. And then we take that depreciable amount and we divide it evenly across the asset's useful life, which is equal to 5 years. So £50,000 divided by 5 years gives us an annual depreciation charge of £10,000. If we want to calculate monthly depreciation, we simply take the annual depreciation charge of £10,000 and divide it by 12 because there are 12 months in the year. So if we wanted to calculate monthly depreciation, we would have a charge of £833 per month. So each year, that £10,000 is charged both to the income statement as an expense, so it reduces profit, but it's also added to the accumulated depreciation figure on the balance sheet. So it's going to reduce the carrying value of the non-current asset over time. So yeah, over time, the carrying amount value is going to steadily decrease, evenly decrease under the straight line method. So at the end of year one, the original cost of the asset is £55,000, but we need to reduce the carrying value amount by the annual depreciation charge of £10,000, which gives us a carrying amount equal to £45,000. After year two, the carrying amount is equal to the cost of £55,000 less accumulated depreciation of £20,000, because we've got an additional £10,000 depreciation charge, which is realised in year two. So the carrying amount at the end of year two is £35,000, and we carry on populating this table following the same sort of steps. So we realise an additional £10,000 depreciation every year. So the accumulated depreciation will increase by £10,000 every year until we're left with a carrying amount at the end of year five of £5,000, which ties to the residual value we were provided with in the question. And that's a helpful check, because if your carrying amount at the end of the asset's useful life is equal to the residual value you're given in a question, then you know you've done your calculations correctly. Cool. Hopefully that example illustrates how the straight line method systematically reduces the asset's carrying value over time, aligning the depreciation charge with the periods in which the asset is delivering economic benefits for the business. Okay. So now let's look at the reducing balance method of depreciation. So this method applies a percentage depreciation rate to the asset's carrying value at the start of each accounting period. So unlike straight line depreciation, the reducing balance method results in an uneven allocation of depreciation over the asset's useful life. So reducing balance depreciation will lead to a higher depreciation charge in the first couple of years of the asset's life, and it's going to lead to a lower depreciation charge in the latter years of the asset's life. And the reason why is because the carrying value of the asset is declining each year, and the depreciation charge amount is always calculated based on that reduced carrying value amount brought forward. Okay, so annual depreciation under the reducing balance method is equal to the carrying amount at the start of the year times by a fixed percentage depreciation rate. And one important point to note for the exam is that when it comes to the reducing balance method, you do not need to factor in residual value. So under straight line, you may need to factor in a residual value amount to calculate your annual depreciation charge, but under the reducing balance method, you'll never need to factor in a residual value. Okay, let's now walk through a numerical example to show you how the reducing balance depreciation method actually works in practice. So we're told that a business purchases a piece of energy efficient machinery for £15,000. It plans to use the asset for 3 years, so it has a 3-year useful life. But rather than using the straight line depreciation method like we did in the previous example, the business is opting to use the reducing balance method, and they select a 30% depreciation rate. So under the reducing balance method, each year's depreciation charge is going to be calculated as 30% of the carrying value brought forward at the start of that accounting period. So our annual depreciation formula that we're going to apply for this question is equal to the carrying amount at the start of the year times by our fixed depreciation rate of 30%. So in year one, the depreciation charge is going to be equal to 30% multiplied by £15,000, which is the original cost of the asset. So that gives us a depreciation charge for year one of £4,500. That leaves us with a carrying amount of £10,500, and our accumulated depreciation for year one is just equal to £4,500 as well. Okay, in year two, we need to calculate our depreciation charge by taking 30% and multiplying that by the carrying amount brought forward from the end of year one, which is equal to £10,500. So our depreciation charge is now, in year two, equal to £3,150, and that is that £10,500 multiplied by 30%. Our accumulated depreciation is equal to our £4,500 of depreciation charged in year one, plus the £3,150 of depreciation charged in year two, which is equal to £7,650. Therefore, our new carrying amount is equal to our original cost of £15,000 less £7,650, which is £7,350. In year three, we follow the same sort of steps. We take 30%, we multiply it by our opening carrying amount of £7,350. That gives us depreciation for the year of £2,205. Our accumulated depreciation is the sum of all of our annual depreciation charges across the 3 periods, which gives us accumulated depreciation of £9,855. So our closing carrying amount, or our carrying amount at the end of year three, is equal to £5,145. So notice how our annual depreciation expense isn't constant like it was when we applied the straight line method. It starts off being higher in the first year, but reduces each year after that. So by the time we get to year three, our depreciation charge is less than half what it was in year one. And the carrying value also declines more slowly as time passes as a result of the reducing annual depreciation charge. So the reducing balance depreciation approach reflects the assumption that the asset delivers most of its value or more of its value early on in its useful life, and it is delivering less value to the business as it gets older and less useful and less efficient. One thing to note, in your ACA exam, you won't be asked to calculate monthly depreciation under the reducing balance method, only annual charges like this. So reducing balance, you won't need to calculate monthly depreciation, and you don't need to factor in a residual value. Okay, on this last slide, we compare the key differences between the straight line depreciation method and the reducing balance depreciation method. So let's start with the formulas. The straight line method spreads the depreciable cost evenly over the asset's useful life. Reducing balance, on the other hand, applies a fixed percentage depreciation rate to the assets brought forward carrying amount at the start of the year. These formulas mean that under the straight line method, the depreciation charge that goes through the income statement every year is exactly the same. Year after year, the annual depreciation charge will be the same. Whereas under reducing balance, the charge is higher in the earlier years and lower in the latter years. Straight line is best suited for assets like buildings, furniture, assets that provide very consistent value over time and generate consistent benefits for the business, whereas reducing balance is used for assets like cars, vans, technology-based assets, which lose their value or usefulness far more quickly, typically in the first year or two. And again, one key difference to remember, the residual value is incorporated into the straight line calculation, but under reducing balance, you do not need to worry about factoring in a residual value amount. Cool, so that's everything I wanted to discuss in this video. That's the two depreciation methods in a nutshell. If you've got any questions about straight line or the reducing balance method, please feel free to fire them off in the comments. I'll be more than happy to answer them. If you like the video, please smash the like button and consider subscribing. And I'll see you guys in the next one.